The market reaction to Trump's tariffs signals a broader acceptance of Bitcoin's digital gold narrative. The response of Bitcoin prices to the destabilizing announcement of U.S. tariffs in April suggests the digital asset may be achieving one of its fundamental promises, says Hashdex's Gerry. You're reading Crypto Long and Short, our weekly newsletter featuring insights, news, and analysis for the professional investor. Sign up here to get it in your inbox every Wednesday. In financial markets, making assumptions based on short-term observations is a fool's errand, as significant trends develop over months and years, not days or weeks. But as investors evaluate Bitcoin's role in their portfolios, the events of April are worth analyzing in order to understand the asset's emerging reputation as a store of value. Backdrop of volatility. The turbulence sparked by President Trump's tariffs announcement on April 2 sent stock prices plummeting the following day, with the Nasdaq 100 and S&P 500 falling 4.8% and 5.4%, respectively. Bitcoin followed suit as the VIX Volatility Index hit levels not seen since the early days of COVID and fears of retaliatory trade measures prevailed. However, Bitcoin's price began to recover sharply within days of the announcement, causing its correlation with both the Nasdaq 100 and S&P 500 to fall below 0.50, before those correlations rose again as the April 9 pause on tariffs brought back risk-on mode. Bitcoin's correlations to traditional markets in April. Source: Hashdex research with data from CF Benchmarks and Bloomberg April 1, 2025 to April 30, 2025. 30-day rolling correlations considering only workdays between Bitcoin, represented by the Nasdaq Bitcoin Reference Price Index, and TradFi indices. This short-term observation matters because it supports the changing nature of how investors perceive Bitcoin. While some still categorize Bitcoin as a high-beta risk-on asset, institutional sentiment is beginning to reflect a more nuanced understanding. Bitcoin recovered faster than the S&P 500 in the 60 days that followed the COVID outbreak, Russia's invasion of Ukraine, and the U.S. banking crisis in 2023, events in which it demonstrated resilience and a profile increasingly aligned with that of gold during stress. These periods of decoupling establish a pattern where Bitcoin displays its anti-fragile properties, allowing allocators to protect capital during systemic events while still outpacing the performance of stocks, bonds, and gold over the long haul. Bitcoin versus traditional assets, 5-year returns. Source: Case Bitcoin, return data from May 1, 2020 to April 30, 2025, casebitcoin.com. The path to digital gold. Maybe more compelling than Bitcoin's longer-term returns are the long-term portfolio effects. Even a small allocation to Bitcoin within a traditional 60% stock/40% bond portfolio would have improved risk-adjusted returns in 98% of rolling 3-year periods over the last decade. And these risk-adjusted returns are markedly higher over longer time frames, suggesting that Bitcoin's volatility from positive returns more than counterbalances short-term drawdowns. It might still be premature to claim that Bitcoin has been universally accepted as digital gold, but that narrative, supported by its response to geopolitical events, is gaining momentum. The combination of Bitcoin's fixed supply, liquidity, accessibility, and immunity to central bank interference gives it properties no traditional asset can replicate. This should be appealing to any investor, large or small, in search of portfolio diversification and long-term wealth preservation. Gerry is the head of global market insights at Hashdex Asset Management. He has over 2 decades of experience in the asset management industry and has been helping investors understand Bitcoin and other public blockchain technologies since 2015. Prior to Hashdex, he ran a digital asset-focused marketing business to support early-stage startups, institutional investors, and diversified financial services firms. Gerry previously worked at Fidelity Investments, where he was responsible for its asset management-related public policy priorities, and from 2015 to 16 served on the firm's executive steering committee overseeing its Bitcoin initiatives. Before Fidelity, he worked in institutional business development and marketing at a global quantitative investment firm acquired by Franklin Templeton in 2020. Gerry began his career in Washington, D.C. as a legislative aide to the chairman of the House Financial Services Committee and Senate Banking Committee.